this exercise will help you to get your homework assignments also done. So let's close this chapter 11. We covered that last week. So here is chapter 12, the last chapter. And I'm going to go all the way to exercise so it can help you to understand the subject and doing your homework assignments. Here we go, exercise. So let's do from number 1. Why not, I believe. So the management is considering an investment with the following cash flows. So they are estimating the cash flows in year 1 will be $1,000, year 2, 2,000, and so forth. The investment in year 1 needs to be $15,000 and additional investment of $8,000. So now they like to determine the payback period of the investment, how long it takes to get that initial investment back. Would the payback period be affected if the cash flow in the last year were several times as large? Okay, so let me tell you one thing about cash flow. Cash flow and payback issue. In the payback issue, one major problem is they're not considering present value of the cash flow. They are just considering cash flow. That's one issue. The next thing is, let's say after 3-4 years, the initial investment has been recovered. But you might think, wait a moment, in next coming years, still there is a big cash flow coming in. So you are literally ignoring that. You're just trying to focus on to see how long it takes the cash flow to recover the initial investment. So I suggest to improve the payback period calculation to use present value of each single cash flow first, to calculate that first, and then use that present value of cash flow into consideration of calculation of payback period. That will be much better payback period analysis compared to just regular payback period. But in your class, it's just showing you what the regular payback period is without considering the present value of that cash flow. Instead, just the cash flow itself. That's fine. But so you know, there is a better way to do it. So let's look at the solution. I should have it somewhere here. So you see, we have $15,000 of investment, and we have $1,000 cash flow estimated in year 1. So we have $14,000 left. We have $8,000 of additional investment in year 2, minus $2,000 cash flow in year 2. That gives you 14 plus 8 minus 2. That's 20. We have 2,500 cash flow in year 3. So 20 minus 2,500 is 17,500. 17,500 minus 4,000 in year 4 gives you 13,500. 13,500 minus 5,000 in year 5 gives you 8,500. So one more in year 6, we're going to have another 6,000. That's 2,500. So 2,500, but we have in year 7, 5,000, right? So how long it takes to recover? So already we have 5 up to here, right? And then we have year 6. Okay, that's up to 6 years. But then in year 7, we have 5,000 divided by 25. 5,000 divided by 25. So that's half of it. So 25 out of 5,000, that's 0.5. 2,500 out of 5,000, that's 0.5. 0.5 year, half a year. So 0.5 plus 6, it gives you 6.5 years, right? 0.5 plus 6 gives you 6.5 years to recover. And that's an approximate estimate, right? Because no one exactly knows what's going to happen in future, but we are just estimating. The bad thing is, again, I said, we are not considering the present value of these cash flows, which is a big issue. Normally, you can convert this to present value and get a much better understanding of how long it takes to get your money back. Also, we are ignoring the rest of the cash flow in payback period, which is another issue. Okay. That's number one. Let's go to number two. Yeah, number two should be good. So let's go read the problem first. Number two says the management is considering the purchase of a $27,000 machine that would reduce operating costs by $7,000 per year. At the end of machine's 5 years useful life, it will have a zero salvage value, so there is nothing coming up from that area as a form of cash flow. The company's required rate of return is 12%. Required rate of return, hurdle rate, minimum required rate of return. Those are weighted average cost of capital, or they call it WACC, WACC. They're all same. That means the company has an expense as a cost for its capital. The cost of capital for this specific company is 12%. Every company is different. So this company is 12% cost of capital. Cost of capital comes from where? From combination of cost of equity financing plus cost of debt financing. And we call that weighted average cost of capital, WACC, WACC. You can Google that, and if you like to get a better idea of what WACC is and how to calculate that, you learn that in a finance course. But anyway, this is 12% given to you. So your company has to use this 12% to calculate its present value investment analysis. And normally companies, they like to have either equal to or higher than required rate of return. So now we have this situation that we are purchasing a $27,000 equipment. It will save us $7,000 per year. Determine the net present value of investment in the machine. What is the difference between the total undiscounted cash inflows and cash outflows over the entire life of machine? Okay, so I have that solution here, I believe, right there. So purchase of machine by itself is minus $27,000. That's an outflow, right? But for 5 years, that's an annuity saving, $7,000 a year saving if we have this new equipment. That's an annuity because it's same amount over and over and over. So $27,000 times factor of 1, because it's present value right now. We need to spend it right now. If you spend it right now, the factor will be 1. But if you're gonna get $7,000 based on 12% minimum required rate of return, you will get a factor of 3.605. Where is that 3.605 factor coming from? I'm going to show you right now. Here we go. So you go to your book, or just Google it, doesn't matter. You find somewhere here, present value tables, okay? And then go to present value of $1 one time. No, not that, because it's just $1 one time. If you have a salvage value, then you use the salvage value with this table to bring the present value calculation of that salvage cash flow, salvage value cash flow. But because it's just one time, we call it $1 one time. We don't want that right now. We have annuity. And what type of annuity? We have ordinary annuity. Ordinary annuity, that means a series of equal payment, but the payment comes at the end of each period. Okay. If the payment comes immediately, the first payment comes today, the beginning of the period, then it's not ordinary annuity. We call it annuity due, because the first payment is due now. Annuity due. But this is a saving that we recognize it at the end of each year, so it is ordinary annuity. So here is present value of an ordinary annuity, and we're gonna use that. So now, what is the minimum required rate of return? 12%. We're gonna do that annually, and for 5 years, 5 series of payment. So here is 5, here is 12, and here is the factor right there. See, 3.605. So now you know where that 3.605 is coming from. So we go here and we say, okay, $7,000 annuity saving, series of annuity payments, right? Saving. 3.605 is the factor. The present value of that series of saving of 7,000 for 5 years ends up to be 25,235 positive. And the machine that we are going to pay right now with a factor of 1, because it's right now, ends up to be 27,000. So 27,000 outflow, 25,000 inflow, and that gives us a negative net present value. Net present value, if it's negative, it's not acceptable. It should be at least 0 or positive, but not negative. If negative, the project is not acceptable. If you don't consider the present value analysis, then 7,000 times 5 is $35,000, right? And then you say, oh my God, because I'm getting 35, but I spent only 27, then that's $8,000 cash flow. Why not? That's a positive number, right? And yes, that's okay as long as you don't go to college and learn anything. But if you go to college, then you understand that there is a present value that you need to consider, because you're going to spend $27,000 now with a factor of 1. But then if you got a series of annuity payment of $7,000 with a factor of 3.6, based on a minimum required rate of return of 12% for your company, that ends up to be only 25,000. And that's where you get a negative net present value, and you say, no, I'm not going to take this project. Cool. Okay, let's do one more. Okay. Company is investing the purchase of a new $18,600 donut making machine. The new machine would permit the company to reduce the amount of part-time help needed as a cost saving of $3,800 per year. So you buy a new machine, and that will save you on labor cost. In addition, the new machine would allow the company to produce one new style of donut, resulting in the sale of 1,000 dozen more donuts each year. The company realizes a contribution margin of $1.20 per dozen donuts sold. The new machine would have a 6-year useful life required. What would be the total annual cash inflow associated with the new machine for capital budgeting purposes? 2, what discount factor should be used to compute the new machine's internal rate of return. 3, using exhibit B2, 12B2 in appendix 12B as a reference, what is the new machine's internal rate of return to the nearest whole percent? In addition to the data given previously, assume that the machine will have a 9,125 salvage value at the end of the 6 years. Under these conditions, what is the internal rate of return to the nearest whole percent? Hint, you may find this helpful to use the net present value approach, find the discount rate that will cause the net present value to be closest to 0. So let's go, there are 4-part questions, so let's go one by one. Annual saving in part-time help, that's $3,800, right? Added contribution margin for expected sales of additional dozens of the donuts, it's 1,000 dozen times $1.20, that's additional $1,200 of contribution margin. So you see we have annual cash inflow because of this new machine of $5,000. Okay, so factor of internal rate of return is investment required and divided by annual cash inflow. We need $18,000 investment divided by $5,000 cash flow. That gives us a factor of 3.720. 3.720. Let me write it down. Okay. Looking in exhibit 12B2 and scanning along the 6 period, because N is 6, N 6 years life, right? Of machine, because of extra 9,100 $25 inflow in the 6th year. Very well. 3.720 is closest to 3. We have to see which 3.7 is close to what? Close to 3.685. I'm going to show you right now. The factor for the 16% N6I 16% and rate of return. Therefore, the nearest whole percent, the internal rate of return is about 16%. So let me explain what that is. But before we go, one more time. In order to find the factor, you say my investment is 18,600. My cash flow is 5,000. So 18,600 divided by 5 is 3.720, right? That means investment is 3.72 times bigger than cash flow, annual cash flow. Okay, now we're gonna see that 3.720 will translate to what type of annual interest rate of return. So we go to here and we go back to present value tables. And then we have also a series of payment, series of saving, 5,000, not saving, additional income. So series of additional income of 5,000. So you go to present value of ordinary annuity, not annuity due table. Remember, if you're Googling it, present value of ordinary annuity. So here is the ordinary annuity. And we say, okay, this is 6 years, right? Useful life. And we are looking at 3.720. So here, going 6 years, 3.720. So 3.720 will fall somewhere in between in here, right? 3.72, fall somewhere in between, right there. So the annual return of this internal return of this investment is about close to 16%, maybe a little bit less, let's say 15.5 or 16%. So that's what this type of investment will have an internal rate of return, right? Now, let's say 16%. Now, is 16% higher than your minimum required rate of return of your company? WACC, weighted average cost of capital, or so-called hurdle rate. If this 16% is higher than minimum required rate of return, then it's a good project, because your minimum required rate of return, let's say, is 12%, and all of a sudden you have close to 16% internal rate of return for this type of investment. Then this is a good investment, because it is giving you higher return than your minimum required rate of return. Make sense? And in part 4 says that, how about if it has a $9,125 cash inflow in end of year 6 because of salvage value. So the cash flow will not be even over the 6-year life of the machine because of extra $9,125 inflow in the 6th year. Therefore, the above approach cannot be used to compute internal rate of return. In this situation, using trial and error or some other methods, the internal rate of return will end up to be about 22%. So because it's one time extra 9,125, that is something that you have to kind of say, oh, wait a moment, I have this much more income. So purchase of machine is 18,600, okay, right now. And in year 1 through 6, you have reduced part-time help of 3,800. You have added contribution margin of 1,200, and that gives you 5,000. That's series of payment. So series of payment based on you're trying to figure out. You don't know it's 22% or not. So you start from 16%, then 17, then 18, then 19, then 20, then 21, then 22, and try to use all these factors one by one to see which factor will give you a net present value of 0. As soon as you get that net present value of 0 with that specific factor, then that is your internal rate of return. So in this situation, let's say we tried all these 16, 17, 18, 19, 20, 21. None of them gave us present value of 0. And then all of a sudden we use 22, and then it gives us a net present value of 0. We use this factor from ordinary annuity table, because series of payment of 5,000 times factor of 3.167, and that gives us 15,835. And then series of one-time payment of 9,125 that we received from salvage value of that equipment after 6 years life. That gives us a factor using $1 one-time table, $1 one-time table, because it's just one time. So we use that and we get 0. So let's write this down. 3.167, that is annuity, 22%, and then it's 0.303, and that's 22%, but present value of $1 one time. So let's go, and I want to show you how do you find that factors. And then because of that, if you add 15,000 plus 2,700, that gives you virtually 18,600, and your net present value will almost ends up to be 0. And that's how you know 22% is internal rate of return for this type of scenario that we have a salvage value of 9,125. So I'm going back and just showing you where that two factors are coming from. So the first factor, as I said, you have to try 16, 17, 18, and keep going till you see which one gives you net present value. So here is 22%, 1, 2, 3, 4, 5, 6. Here, 3.167. That's where it's coming from. Series of $5,000 saving if we buy new equipment. 3.167 is the factor. And you use that, and all of a sudden net present value ends up to be 0. And that's how you know your internal rate of return of this investment is 22%. Assuming your WACC, weighted average cost of capital, is, let's say, 12%, then it's hell of an investment, right? Awesome investment. Now, the other factor is salvage value. Salvage value is just one time. And you go to present value of $1 one time table. And then you go all the way to try 16%, 17%, 18%, 19%, 20, 21, and 22. And finally, when you use 22 as your return, and you go 1, 2, 3, 4, 5, 6 right there, year 6, and that's 0.303, and you use that, and then you see that your using those factors, then you see that your net present value ends up to be 0, and that's how you know how to calculate the internal rate of return of a product, of an investment that has some annuity payments or savings or cash flow, plus some present value of $1 one time, because it comes like salvage value at the end of year 6, just one time. You use that and multiply and then add, and then you see that's equals to 18,000 almost. It might be a few dollars off, doesn't matter. But as long as it's 0 or very close to 0, you know that's you're about right. You are about 22%. Makes sense? So this is not rocket science that you say, oh, is it exactly? No, it might be 21.8. It might be 21 something. It might be close to 22. So bottom line, as long as it's net present value close to 0, that's how you figure out what is your internal rate of return of this specific investment. And then you compare that to your minimum required rate of return. If it is higher internal rate of return, it's a good project. You might suggest to accept that project. Okay. Anyway, guys, I appreciate you taking my course. This is chapter 12. Obviously, you need to read your book, has good examples. I did some problems for you, but you might have some few more problems to solve it. So I want you to read your book and study the PowerPoint that I provided to you. And my lectures are recorded on that one version of the PowerPoint. And hopefully you get the idea to solve the rest of the problems in your homework assignments. Thank you so much taking for my course. This is our last meeting. I covered all 12 chapters. We have 2 more weeks, looks like, to go. So that's fine. Make sure you submit your project on time, take the exam 3 on time, and that's about it. If you have any questions, definitely email me, and we go from there. Okay. We will have I will have office hours again for the next 2-3 weeks. So if you want to talk about anything, use my office hours. Normally I'm on time. If I'm sometimes 2-3 minutes late, 5 minutes late, that's fine. Just hold on and I will show up for sure. If you see I'm not taking you in, it might mean that I have another student also. So again, just be patient and I will be there for you. Bottom line, email me if you have any questions. Thank you so much for taking my course, and I wish you luck.